The merits of long-term investing. John is a passionate investor who thrives on achieving his financial goals. He prefers to self-manage his investment portfolio and constantly seeks promising opportunities. But recent market turbulence threw him off track. Monthly returns fell short, and news of volatility fueled anxieties. John is re-evaluating his strategies. One day, John meets Mary, an experienced AIA financial advisor. During their conversation, Mary mentions the importance of long-term investment strategies and the benefits of staying invested. Intrigued, John asks, "Long-term? But individual investors often seek quick wins." Mary smiles, "Absolutely. Short-term wins can be exciting. But true wealth creation is a marathon, not a sprint." Think about training for a marathon. You wouldn't focus solely on the final few meters, would you? You'd build a strong base, train consistently, and adapt your strategy for different terrains. John ponders this. "So, you're saying investing requires a similar approach?" "Precisely," Mary continues. "By focusing on long-term goals and staying invested alongside a diversified portfolio, it can help investors weather market volatility and capitalize on long-term opportunities and the positive impact of compounding. It smoothens the path to success where one does not miss out on market best days." Looking at historical MSCI All-Country World Index over the last 20 years, the longer you stay invested, the higher the likelihood of gaining positive returns. Specifically, investors who had stayed invested over a one-year period has a 73% probability of generating positive returns. This probability increased to 89% if the investment is held over a 5-year period. It's important to remember that even all else being equal, a diversified portfolio may also experience losses. Hence, having a longer investment horizon can help you to focus on the big picture in achieving your financial goals. But how do we deal with the short-term fluctuations? That can be scary, and some might get discouraged along the way, John asks. Mary acknowledges the concern. That's valid. Short-term fluctuations are inevitable, but a long-term perspective helps you stay focused and avoid making short-term emotional decisions. Emotions can cause us to make suboptimal investment decisions, chasing after market fads and ending up buying high, selling low. Any attempt to time the market may end up missing market's best days, impacting your long-term returns. The best way to avoid that is to stay invested to weather out the volatility and not having to chase after markets. Looking at MSCI All-Country World Index over a 10-year period, it generated a total return in excess of 200%. However, when one misses market's best 10 days, your returns drop to 140%. Missing market's best 20 days leaves you barely breaking even, and missing the best 40 days results in a 29% loss. John is impressed. "Wow. This is definitely impressive. When is a good time to start? Should I wait for the next bear market before investing?" Excellent question, John. In a bear market, investors may panic and sell their stocks, driving prices lower, whereas in a bull market, stock prices are generally rising as investors feel optimistic and buy more stocks. Looking back at the MSCI World Index in the last 55 years, there were 8 bull and 7 bear markets. On average, bull markets lasted for 70 months with a cumulative 227% return. Comparably, bear markets lasted for 13 months with a 33% loss. We can observe that bear markets are generally shorter and less impactful compared to bull markets. By staying invested, you can ride out these ups and downs in the market, participating in potential gains during bull markets and weathering some losses during bear markets. So, there is no best time to start, but rather start whenever you are ready. Remember, Mary concludes, Long-term investing may still undergo market fluctuations and changing market cycles along the investment journey. The merits of focusing on the long term and staying invested will help weather market fluctuations and avoid missing out on market best days that may impact your long-term returns. John felt a renewed sense of confidence. He thanked Mary for her insights and was eager to learn more and apply the long-term investment strategies for his investments. In AIA, we always take a long-term view, measured in decades, not years, quarters, or months. We are dedicated to deliver long-term, sustainable returns for our customers. Unlock the potential of long-term investing and get started on your path to powering your financial well-being with AIA Investments.